Hey there, savvy investors, and welcome back to the channel where we demystify the markets. Today, we're diving deep into a fascinating corner of the stock market, hard to borrow stocks and the mechanics behind a potential short squeeze. We're going to pull back the curtain on a specific company that has popped up on our screeners, NCT Limited, ticker NCT. This isn't just theory, we're using real numbers and real company data to show you exactly how these dynamics play out. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show NCT ticker and company logo. Let's talk about NCT. NCT Limited operates in the industrial sector, specifically within marine shipping. This micro-cap company, through its subsidiaries, provides maritime shipping services in Hong Kong and internationally, offering time charter and vessel management services worldwide. Interestingly, it's also involved in the processing of pulp, paper, and paperboard products. It's a relatively small fish in a big ocean, which makes its recent activity even more intriguing. Looking at the charts, NCT has seen some significant upward movement recently. Today alone, it's up a robust plus 5.58%. Over the last 5 days, that gain expands to plus 11.83%, and if we stretch back 30 days, NCT has surged an impressive plus 48.97%. Show price chart, highlight increases volume-wise. Today saw 827,064 shares traded, which is a bit below its 30-day average volume of 1,210,222 shares, giving us a relative volume of 0.7x average. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? At its core, it refers to the cost to borrow, or CTB fee. This is the annualized interest rate that short sellers must pay to borrow shares of a company they want to short. Think of it like renting a car, you pay a daily fee to use it. Short sellers pay a fee to use someone else's shares. When a stock is in high demand to short, or the supply of shares available to borrow is very low, that fee skyrockets. It can even exceed 100% annually, meaning short sellers are paying more than the stock's value per year just to hold their short position. This fee matters immensely because it's a constant drain on a short seller's profits, putting immense pressure on them to be right quickly or cover their positions. Why this stock is hard to borrow right now. Show CTB screener numbers. This brings us back to NCT. NCT Limited has landed on our hard-to-borrow screener for a very specific reason. Its annualized cost to borrow fee is currently sitting at an eye-watering 677.5%. That's not a typo. Imagine paying over 6.5 times the value of the stock annually, just to bet against it. This isn't a normal rate, it signals extreme demand from short sellers and or an incredibly tight supply of shares to lend out. With an estimated float of just 0.3 million shares, NCT is a micro-float stock. Highlight 0.3 M shares. A small float means fewer shares are available for trading and, critically, for borrowing. Our data indicates the shares currently available to borrow are unknown, which often means they are extremely limited, if not zero, at many brokers. Our internal composite squeeze score for NCT, which factors in CTB, float, volume, and other metrics, comes in at 42.5 out of 100. While not the highest score we'd ever seen, a CTB of 677.5% for a microcap with a tiny float makes NCT a standout. Now, it's important to remember a high cost to borrow does not guarantee a squeeze. Sometimes, short sellers have extremely strong conviction in their bearish thesis and are willing to pay these exorbitant fees to stay short. Squeeze mechanics explained. So, what happens if that strong short conviction starts to waver, or if buying pressure simply overwhelms the shorts? That's where a short squeeze comes in. When a stock's price rises significantly, short sellers start to lose money on their positions. If the losses become too great, or if the cost to borrow becomes unsustainable, they are forced to cover their shorts. Covering means buying back the shares they initially borrowed and sold. But here's the kicker, when a short seller buys back shares, it adds to the buying demand in the market, further pushing the price up. This creates a vicious cycle for shorts. Rising prices force more covering, which pushes prices even higher, leading to more covering. For NCT, with only 0.3 million shares in its estimated float, even a moderate amount of forced covering could have an outsized impact on the share price because there are simply so few shares available to buy back in the open market. Dilution risk check. Show no dilution risk on screen. One critical factor that can make or break a short squeeze thesis is dilution risk. Dilution happens when a company issues new shares, increasing the total number of shares outstanding. This typically reduces the value of existing shares and can flood the market with new supply, essentially providing short sellers with an easy way to cover their positions, thereby crushing any squeeze potential, no matter how high the cost to borrow. For Intercont Cayman Limited, our checks show no recent diluted SEC filings, such as -1s, -3s, or 424BS, found in the last 90 days. This is a positive sign for any potential short squeeze scenario because it suggests the company isn't currently planning to flood the market with new shares that could be used to negate price appreciation or allow short sellers an easy exit. Also, we found no recent reverse splits for NCT in our look-back window. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. If you are watching NCT, keep an eye on a few key indicators. First, sustained buying volume, especially on green days, that pushes the price higher. Second, continued high or even increasing cost to borrow fees and a decreasing number of shares available to borrow. If the unknown for borrowable shares remains or shrinks further, that's a signal of extreme tightness. A significant increase in short interest, which measures the total number of shares shorted, would also be a bullish signal for squeeze potential, assuming those shorts eventually need to cover. Remember, NCT is a micro-cap stock with a very small float, meaning it can be extremely volatile and prone to large price swings in both directions. So there you have it. Intercont Cayman Limited, NCT, presents a compelling case study in hard-to-borrow dynamics, driven by its astronomical 677.5% cost to borrow and its tiny 0.3 million share float. While a high CTB doesn't guarantee a squeeze, it certainly puts immense pressure on short sellers, especially in a micro-cap with limited share supply. As always, this information is for educational purposes, helping you understand the mechanics behind these unique market events. If you found this deep dive into NCT helpful, please hit that like button, subscribe for more unique stock insights, and let us know in the comments what other hard-to-borrow stocks you'd like us to cover next. Happy trading and stay informed.